In finance, the loudest events, the market crashes, the big booms, they often get all the attention. But sometimes the most important signals, they're quiet, almost silent. They're these little tremors deep in the bedrock of the system. And today, that's what we're going to do. We're going to decode one of those signals. Our story starts way back, 1792 to be exact. This is the year a true bedrock of American commerce was founded. We're talking about the United States Mint. Now think about that for a second. This institution has been operational through everything. A civil war, the Great Depression, 2 world wars, you name it. For more than 2 centuries, it has been the very definition of consistency, an absolute symbol of stability. So why would an institution that has weathered every single storm imaginable suddenly go silent? And not just on anything, but on its most popular silver product. This isn't just a rhetorical question. An institution like this doesn't just stop. The why is the signal we're here to interpret. And that's the core fact right there. The U.S. Mint has indefinitely, and that word is key, indefinitely suspended sales of American Silver Eagles. We're talking about the world's most recognized, most sought-after sovereign silver coin. And you just can't get it from the source anymore. But here is where it gets really, really interesting. The official reason they gave? We simply cannot price it. Just let that sink in. This isn't some excuse about supply chains or a lack of silver. This is a direct admission from a sovereign mint that they literally can't figure out what the price should be. They're telling us the market has broken their models. Okay, so something like this, it doesn't just happen in a vacuum, right? An institution like the Mint struggling to price a timeless asset, well, that's just a symptom. To really understand the signal, we have to look at the source, at the tremors happening underneath the entire system. And look at this. This chart really puts it into perspective. It shows the staggering amount of currency that's been created recently. We're talking more in the last handful of years than in the 50 years before that combined. Now, when the very ruler you use to measure value is stretching and shrinking like this, well, trying to price anything becomes a massive challenge. It's a fundamental law of capital, really. All this new money, it has to find a home. It has to go somewhere. And where does it go? It flows into hard assets, things that can't just be printed out of thin air. And this is the primary force that's stressing the entire system. So here's the key takeaway. The Mint's problem isn't that silver has suddenly become wildly volatile. No. The real problem is that the dollar has become too unstable to be a reliable measuring stick. The signal isn't about the thing being measured, it's about the ruler itself. Now, this brings us to the first pillar holding up all this stress in the market. It's a fundamental shift in what silver even is anymore. It's not just a monetary metal. If you look at where silver demand comes from today, the picture has completely changed. Industrial use is now the big one, the dominant driver. This means silver isn't a luxury item anymore. It's a strategic, absolutely critical input for our entire technological infrastructure. And this demand isn't speculative. It's what we call inelastic. You simply cannot build the green energy grid. You can't build the next generation of electronics or electric vehicles without it. This isn't a choice for manufacturers. It's a physical requirement for progress. This shows you a really critical difference between silver and, say, gold. Unlike gold, which gets recycled and stored, industrial silver is consumed. It's used in tiny, tiny amounts across millions of products, which makes recovering it pretty much impossible. So it's effectively taken out of the supply forever. And I want you to just sit with this for a moment. Just one industry, the solar industry, is on a path to needing more silver than we even know exists in all the stockpiles in the world. This isn't just a prediction of higher prices. This is a forecast of a structural, long-term supply deficit.
It's baked into the cake. So you have this intense physical scarcity building up, right? Well, that pressure gets magnified by our second pillar, the massive and frankly fragile financial system that's been built on top of this shrinking physical supply.
What's happened is we now have two totally different silver markets that are running in parallel. In the real physical world, if you want to get your hands on metal, you're looking at long delivery delays and paying huge premiums over the so-called spot price. But in the paper market, you can trade massive quantities of claims on silver in an instant. These two realities are pulling apart, and that kind of disconnect, it never lasts.
Some very credible estimates put the ratio of paper claims to physical silver as high as 500 to 1. Think about that. For every 1 single ounce of actual physical silver sitting in a vault, there could be up to 500 different paper claims on it. That's what you call extreme leverage. It means if everyone with a paper claim decided they wanted their physical silver at the same time, it's just not possible.
And when you have a 500 to 1 ratio, counterparty risk stops being some abstract theoretical concept. It becomes a mathematical certainty in a crisis. The whole paper market is just a web of promises, and it's a web where not all promises can be kept at once.
And this gets us right back to the question the U.S. Mint is wrestling with. If the paper price is just an illusion held up by leverage and the physical price is all messy with premiums and scarcity, well, how do you find the real price? The entire mechanism of price discovery has broken down.
So on top of the industrial demand and this paper paradox, we have a third pillar compounding the problem: the sheer fragility of our global supply chains.
You see, the world's silver doesn't come from a nice, diversified group of stable countries. It's highly concentrated in just a handful of nations. And frankly, many of them are dealing with significant political and economic instability. This concentration is a major weak point, a critical point of failure in the system. And we're also entering a new era here. It's an era of what we call resource nationalism. Nations are starting to see their natural resources not just as commodities to export, but as strategic national assets to be protected. I mean, think about it. If your own currency is failing, why would you export your real, tangible wealth for paper promises that are losing value every day?
And this isn't some far-off threat. This timeline shows you just how fast a political decision in one country can trigger a global physical shortage. One export tariff, one act of nationalization, one new mandate to build a strategic reserve. Any of those things could sever the supply chain almost overnight. It would make the scarcity we're seeing now look like nothing.
So let's put the pieces together. We've got intense industrial scarcity, a fragile paper market built on leverage, and a fractured geopolitical landscape. When you look at all of that, the U.S. Mint's decision to just stop, it actually makes perfect sense. It's their verdict on the state of the entire system. Because the real story here isn't the day-to-day price of silver. Focusing on that is just noise. It's missing the forest for the trees. The real story is the convergence of these three powerful forces: unstoppable industrial demand, relentless currency debasement, and growing supply scarcity. This is the signal. When a sovereign government mint, an institution that's been around for over 200 years, can no longer trust the market's ability to produce a rational price, that's a massive vote of no confidence. It's a statement about the entire system of financial abstraction we've relied on for decades. What it really means is that we're all operating with old maps. Our economic models, our financial instruments, they were built for a world that doesn't exist anymore. The physical realities, the geopolitical dynamics, they've changed the territory completely, and the old maps are now dangerously misleading. And this is the paradigm shift you have to understand. The last big run-up in silver back in 1980 That was driven by investors speculating on inflation. What's happening today is completely different. It's underpinned by real, non-negotiable industrial demand. That gives the current situation a solid foundation that simply wasn't there before.
All of this leads us to a final verdict, a final idea. In a world where the signals are failing, the goal isn't just about speculation anymore. It's about achieving what we call financial sovereignty. It's about holding assets that are truly yours, assets that are not simultaneously someone else's liability. And so this is the only question that really matters now. When the official institutions are openly admitting that they're lost, you have to navigate by your own compass. The signal has been sent. The interpretation and the action that you take from here, well, that's now up to you. Before we depart, remember, the financial landscape is constantly shifting. The insights shared here are for educational and informational purposes only. They do not constitute financial, investment, or legal advice. Every investor's situation is unique, and you should always consult with a certified professional before making any significant financial decisions. Our goal is to help you find the signal, but the final move is always yours. Stay sovereign, stay informed.